Hey, what's going on, guys? This is Mark Levinsky here, CEO and founder of Enter Sky Incorporated, Enter Sky LLC, and then the nonprofit, the Susie Dalk Foundation. I'm a real estate investor and agent here in Arizona. I invest all over the country, specifically currently the Midwest. So that's Arizona, Texas, New Mexico, Utah, um, and so I'm an investor. I predominantly focus on real estate investments and passive income. I prefer real estate over stocks and bonds. And so, just a little bit about me. I am a prior service veteran. I filed bankruptcy a little over a year ago, and I've seasoned it for about 12 months. I had the opportunity to do one of three options. That was the debt consolidation, it's chapter 13 or chapter 7 bankruptcy. I ended up choosing chapter 7 bankruptcy because it made the most financial sense. A lot of times you can do debt consolidation. I had a little over $155,000 worth of credit card debt. When I had started, I had over $2.8 million worth of debt. That was a total of 14 houses that I owned at the time. So I had mortgages, I had liabilities on loans, on car loans, and stuff like that for my businesses. I had equipment loans, lines of credit, credit cards, personal credit cards, business lines. And I ended up liquidating most of my assets. So at the time I had, like I said, 14 flips. 13 of those were actually done. I had 4 real estate properties that were like in federally backed loans. So one was an FHA, one was a VA, one was a USDA, and then I have one that actually wasn't recorded, but I'm seller financing the loan. So that's why I actually ended up keeping it. I didn't put it on my bankruptcy. So that was not something that was ever public record or knowledge. So I was able to keep that through my bankruptcy because it was never added to it. And a lot of my personal assets were considered secondary homes or primary residences during the time of my bankruptcy. So I was able to keep those. In addition to that, there wasn't enough equity at the time of the bankruptcy to liquidate the asset and pay off some of my debts. So what ended up happening is when I was acquiring my flips, I used investors to hold the down payment carrying costs and some of the construction expenses. So in the primary position was actually hard money loans. So these are interest only loans that are focused on charging you 12% interest only for a 6 to 12 month period. It depends. Every business model is different. Every hard money lender has different requirements. The ones I was using offered hard money only at a 12% for up to 6 months with an extension period of a fee worth $200 for an additional 6 months at a 12% interest. And so I had 13 homes all on a 12% interest only rate. And then I had people in second position that were holding the down payment, the carrying costs, and their return. So my typical return for my investors at the time was 20% return on their investment. So if someone invested $50,000 from their IRA, 401k, or bank account, or even credit cards, I would calculate how much interest they would be paying based off of if they borrowed a credit card or not, and then put them in second position for the money they invested plus their 20% return on investment. So I would add their 20% plus interest expense in principal payments to their 50K. It would be around $70-ish thousand. It would put them in second position, and they would be right behind the primary hard money lender. And that's how I did. That was my business model. That way they were able to be paid out by escrow for holding a note rather than being paid directly from me. I just felt like that was a lot safer than handing people checks. So when it came to tax season, there was a chain of title that could follow and prove why I wasn't paying taxes on that, because I was receiving less income for flipping these houses. Because they would get paid, the hard money lender would get paid, and then what was ever left would get paid directly to me, and that would be what I would be paying taxes on. Usually, I would try to get my contractors to cloud title. Never been successful with that, but there is a model that people do that, where they will pay their contractors a certain portion, and then they will give them an additional fee to pay them to basically cloud title with a mechanics lien. That way, they get paid at escrow rather than up front, because it makes it easier when you go to, again, tax season, to pay them back. Instead of, you know, itemizing your deductions, you can have basically title itemize your deductions for you, and it makes it less, it provides, it's less work, honestly, at the end of the year. And during your pro forma and every flip, if you just have escrow company pay out everybody. And so I did that a lot. That was my primary goal, was to have the escrow company, because they're a professional that keeps track of their accounting probably more accurately than I was at the time. So it was easier to have everybody cloud title. And then what was ever left was considered profit that I would just pay taxes on at the end of the year. Luckily, what ended up happening before I filed bankruptcy to go from $2.8 million to $150,000 with a personal credit card debt was basically I was putting people that were in second position that had houses already finished or through the process of getting finished. I was handing them deeds for their position. So if they gave me $60,000, I was removing their cloud that I initially put, getting them to get the hard money loan to take over the other one that I had, and then handing them title or ownership of the property. So basically I was selling it to them for free, so I didn't have to pay taxes on it or realize any income, and I could get rid of the debt. So I did that with 13 out of the 14 properties. The 14th one ran into a little bit of a hiccup. Basically, that property was worth $350,000. At the time, I had about $270,000 worth of work put into it, but there was only really $200,000 worth of actual work done. And that's pretty much what I purchased the property for. And for me to see that property succeed, I would have had to have dumped an additional $70,000 into it. So by the time it would have actually gotten done, completed, and sold, I would have ended up breaking even. Assuming that I only paid a buyer's agent for sales fees, and they would have basically had to sell it for or buy it for 1%. And that just it wasn't a sustainable model, and it was just that one property just I kept losing money on it. I wasn't vetting contractors correctly. I wasn't doing things correctly like I should have. I wasn't maintaining my accounting very correctly. I wasn't borrowing money the necessary way that I needed to. I under borrowed. And so I was shorter on funds than I needed to be. And it just a combination of being short on funds and having shitty contractors at the time, I wasn't able to actually be successful, which is why when you vet contractors, you really need to ask for three things: their insurance information, their license number, and their bond information. Because what happens is if they're licensed, bonded, and insured with the city, you can actually go after their license or their bond number or their insurance policy and recoup the money that they may or may not have stolen if that ever happens to you. And that's something that I neglected to do at that time because I was just so worried about cutting corners and saving an extra $100,000 or $20,000 or so. And because of that, I ended up losing hundreds of thousands of dollars in terms of profit. My original profit margin on that property was about $70,000. And it went from $70,000 very quickly to a negative $30,000 profit margin. And it was just because I didn't vet my contractors correctly and borrow the correct amount of funds, which alleviated me to cutting corners, which alleviated me or derived me to getting to terrible contractors. Since then, I mean, that was the only property I've ever done that on. So I don't know why I thought that was a good idea. Obviously it wasn't. I ended up losing everything. So I ended up originally signing a contract with a debt consolidation company, and that debt consolidation company put me on a plan, $1,500 a month for the next 5 years. And then after 6 months, they would consolidate all of my debt into a trust account, start negotiating about 25% of it down. And then after that first 6 months to a year, after they would pay off most of my debt and settle, I would end up going to a 3-year loan to rebuild my credit up. And that's usually how debt consolidation works. If you pay for a secondary party, they usually set up a trust account, you make a minimum payment, they negotiate the debt for you as professionals. They get anywhere between 25 to 50% of the actual money that you owe, and then they give you a loan to rebuild your credit. Well, I thought about doing that myself and not actually paying them for it, and negotiating with the creditors. After I did some calculations real quick and did some math and kind of thought through the process of how long it would take, at that time, it made more sense for me just to file bankruptcy and, rebuild my credit immediately following my bankruptcy, because it would have taken me 3 to 5 years to actually rebuild my credit and get it back to where it was, to where I had over $250,000 worth of lines of credit spanned out through 10 cards or 10 creditors. And so to me, that made more sense because it was just a cut it clean kind of scenario. So then I looked into chapter 13 and I did the math, and it would take me 3 years to pay off that debt, and then an additional 2 years again to fix my credit. So it was just like I could either pay $1,500 or I could pay $300. And to me, it was like, why am I even paying these creditors at all when I could just do chapter 7, 6 months later, reboot my credit, have that chapter 7 on my credit score for 2 years if I want to get another federally backed loan like an FHA, VA, or USDA loan, and then just to start purchasing properties again and use that 2-year period that I need this season to rebuild my credit profile, get a better paying job, humble myself, re-educate myself on what the proper steps are to flip a house, rebuild some of my profile in terms of what type of investor I am, and readjust my strategy. And so that's what I've been doing for the past 18 months ish, is kind of rebuilding my credit and kind of building back my credibility, going to investors, seminars, getting my education, commissioning as a lieutenant in the Army, and then just going to school and re-educating myself on a more higher level. And so the difference was from what I'm doing now compared to what I was doing then, is right now I'm working on my business rather than in it, where before I was working in my business. So I was a sole proprietor. Basically, a sole proprietor is someone that works like a 9 to 5 pace. They work inside their business as one of the people that actually operate the business, versus someone that works on their business. This is someone that finds someone else that they would hire to do their role. So all that person that's working on the business does is create systems and oversees the process, right? So if you're a sole proprietor, you may be an agent, real estate agent. You sell people's houses, you do all the contracts, you handle all of the sales calls, you close all the deals, you sign all the paperwork, right? But once you become a broker or a team leader, right, your position changes from being a sole proprietor, someone that does all of the work, to, okay, now I have a transaction coordinator that handles all of the transactions and negotiates all of the contracts and handles all of the BINSR reports, buyer information responses. They handle all of the list. Then you can get a listing coordinator that handles all of the listings, does all of the marketing for you, handles all of the seller documents, and handles all of this, the seller disclosure forms and whatnot, the spuds and everything that you need for that. And then you could even have agents. You could have agents making all of the sales calls for you, earning those commissions. Maybe you're an 80-20 split or a 50-50 split, and that's what you use to pay all of your employees. But that's typically, the difference between someone that works in their business versus someone that works on their business. The person that works on their businesses usually create processes and kind of oversee the general operations, but don't actually work in their business. They just kind of oversee everything and create high level, macro perspective, directional guidance, versus someone that works in their business, focuses on a particular niche in that operation, but doesn't really know what the rest of their employees do or the rest of the process, or they do everything. And so they're a very small encompassed owner that maybe has 150 clients that they conduct transactions for, once or twice a year. And so they make a very modest salary. To me personally, the difference between someone that works in their business versus someone who works on their business is the level of income and the amount of work you do. Neither one of them are wrong, but I'm not the type of person that wants to be working in my 50s, working in my business. I want someone else to do my job for me. I want someone else that I could tell what to do and see them accomplish it, even if it's a shitty job, as long as I'm still receiving income passively. And as all I have to do is tell them, hey, this is what you need to do. This is how you should do it. create a process, document it, so if you ever get fired, well, it's there. So that's what more or less I want to do. I want to oversee an enterprise rather than actually just doing the work. I think that's a better model for expansion, and there's a lot of entrepreneurs that say the same thing. So if you ever read business books, a lot of people talk about, specifically Robert Kiyosaki talks about working on your business rather than in it. That's the difference between an investor and a business owner versus an employee or a sole proprietor. Sole proprietors and employees usually work in their business, versus business owners and investors work on the business itself and the structure and really oversee everything. And so what I want to accomplish with this is kind of document, not only for myself, but other people that are interested, on what I'm doing currently to go from, 1 year after bankruptcy to building a business again and doing it correctly and ensuring that I'm following the correct processes. So recently I've sat down with some investors that are interested in funding my fix and flip business and basically giving me a certain amount of capital to oversee the success of that business. And I mean, there are still some things that have to be knocked out, and there are timelines that have to be met, and there are credit requirements that they may or may not want. And hell, they may even want to be part of my entity long-term in terms of equity. And so those kinds of things need to be worked out a little bit later. But at the end of the day, this whole series, I kind of just want you to see what I'm doing as a 27-year-old male that's trying to build a business and kind of get an understanding of that. So, I mean, I kind of want to have content out on a daily basis, but this particular portion of content I want to have out on a weekly basis. So, I was from the time that I became homeless as a senior in high school to the time that I joined the military and worked 3 jobs and started flipping houses and buying and holding for an ex-wife's trusts, to the time that I got out and started flipping houses, to the time I went bankrupt, to now. I kind of want you to understand that, like, I've experienced a lot of life. I know what it's like to be cheated on by a spouse, or being divorced, or even war. Like, those things have had a serious impact on the way I perceive the world and business. And I want to be able to express or share those kinds of experiences with you and how they directly correlate to the success and ideals of what a real business should look like. And so I'm hoping that, this video kind of motivates you to listen, or maybe you don't care. I mean, at the end of the day, this is really for me and not for you. But if it's something you're interested in, I mean, follow along. It's great information. A lot of people don't even know how to start a business for $35. It's actually really easy and really cheap and really fast. So I'm probably going to get together. I'm going to have these videos out once a week on Mondays. I'm trying to have them out starting next week around 7 a.m. So if you want to tune in and watch and see like what the 10-minute thing I did that day, or that particular task, and kind of just, sit on it for a week and see what I do the next week, like, by all means, like, tune in. I'm trying to make them at least 10 to 15 minutes. So that way, just kind of explain what I'm doing, show you what I'm doing with Zoom. And so you can see what I'm, the processes in which you could take. Every state's a little different. Like, I operate in Arizona, so my entities are formed in Arizona. My EINs are formed in the IRS.gov website. So when I get my entity structures and my corporation documents from the state of Arizona, I will then move into setting up my DUNS number, my triple B identification, and then my EIN. And then after that, I'll probably do a vlog or something about going into a bank and finding out what type of banks are best for me. And I'll be bank shopping and kind of going through that process a little bit and just setting up the overall structure. Additionally, I plan to go over some stuff that I find helpful in my life, like health and wellness, like what I eat in a day, and like the type of training I do, and how it benefits my military career in the National Guard, and how it benefits my education at ASU, Arizona State University, and exercise routines and stuff. Additionally, I kind of want to go over some financial literacy. People that don't necessarily know what an ROI is, or return on investment, or internal rate of return, or IRR, or cash on cash, or like what a syndication is. I kind of want to, go over those and explain more or less what those are and how those are important to the success of virtually anybody, whether you flip houses or invest in stocks. Um, and so I just want to, kind of go over that with you once or twice a week, and then talk a little bit about politics and some of the current events that are going on and how those directly affect business owners, specifically in the United States, and what states are probably better or worse for operating businesses. I mean, but I'm not, by no means an attorney or CPA. I am a Arizona real estate license agent. Um, I have taken my mortgage loan originator's license. I have taken um, my insurance sales license specific to car sales, and home insurance. But I'm not a licensed insurance broker. I'm not a licensed mortgage loan originator, and I'm not a broker. I am getting my broker's license eventually, but I'm currently not. I just use my license to sell the homes that I flip, and I've never done that specifically with my license. I didn't start selling home. I actually haven't sold any homes on my license yet. So I ended up filing bankruptcy and losing all of my properties before I could sell them before I got my license. So I've had my license 2 years. I was never able to actually sell with my license. And it's not my focus. I don't usually take clients on. I don't like to help investors. I do wholesale sometimes, and I do disclose it on my on my contracts. But for the most part, I don't sell on my license. I just don't. I don't see the purpose of it. There are so many other ways to make income through real estate. To me, representing a client is a lot more risky than it is to actually do things in investing, like flip homes or wholesale property to other investors that are significantly more sophisticated than your average person that purchases a home. And I don't do commercial sales. I understand it. That was actually primarily how I had learned real estate, at least at the university level, is stuff like value add and syndications and stuff. Eventually, I do plan to get into syndications and developments. I've created executive summaries and whatnot, and marketable comparisons for developments through like LEED and WELL certificates. So I actually put together a team of developers who are now doing their own thing after me. So, and I know they're going to be successful. I think they're building currently in Scottsdale, Arizona. They're currently in negotiations for some properties. I'm hoping to have them on here and kind of talk about what they're doing a little later on once they've made it past the close of escrow and they've started development. So who knows? We'll see. I'm hoping that kind of goes well for them and for me, and get along for the ride, I guess. All right. See you guys.